because I have to wait for a half an hour to charge it up. I mean, you're going to just get stuck. I feel like I'm not personally or professionally ready to jump into a charger, but maybe you are. I mean, excuse me, a electric car, but maybe you are. Maybe you're ready to actually go and purchase an electric car because you have a half an hour to just sit and wait for the car to charge. I don't have a half an hour to sit and wait for the car to charge. Even if it looks as cool as this thing, like this looks like a concept car from Tron. Do you remember Tron, that movie Tron? Um, like the old one and the new one. They had a lot of good looking technology there, but this is the best looking of the bunch, but I don't think that I would just be dying inside if I had to wait 45 minutes for a car to charge. So that's what Hondas are doing. Um, you know, so the jury is still out on whether or not this is going to be really popular with the public. So I guess we'll have to wait and see, what happens. So I was scrolling the interwebs the other day, and I found an article about the Supreme Court hearing a tax case on income. And I was kind of hesitant to share it on the show because sometimes taxes are boring, first of all. And if you're not a legal file or someone who enjoys legal stuff, then you think that's boring. Now, when you mix a legal case with taxes, then you basically get the death penalty. And it's super boring. So I wasn't sure if I wanted to do it, but I decided to bite the bullet tonight and to share this article because I felt like this might be something that everybody needs to hear. Because the result of this case could have an effect on whether you're a business owner or not, but if you have investments or if you own a corporation that has pass-through income, LLC, S Corp, right? So let's take a look. All right, so here it is. It says the Supreme Court is set to hear oral arguments Tuesday on a case that could affect broad swaths of the U.S. tax code and federal revenue. The closely watched case, Moore v. United States, involves a Washington couple, Charles and Kathleen Moore. They own a controlling interest in a profitable foreign company affected by a tax enacted via former President Donald Trump's 2017 tax overhaul. That was the American Rescue Act that I believe the 2017 overhaul. It said that the Moores are fighting on a levy on company earnings that weren't distributed to them, which challenges the definition of income and could have sweeping effects on the U.S. tax code, according to experts. So basically, here's what we know about this case, and I'm going to kind of break this out a little bit. So the Moores, Charles and Kathleen Moore, invested in a company in India, and the company ended up being profitable. Now they have a foreign entity that invested in this company in India, which ended up, obviously gaining money. But here's the problem. The problem is that when that company that they invested in became profitable and earned money, they didn't take the profits. They kept it in the business. So it was retained earnings because they didn't pay out a dividend and they didn't take it in some other form. It just sat there as retained earnings. So it was unrealized income. However, there is a tax stipulation for foreign business that's known as deemed repatriation, which is basically designed as a transition tax. It says that the legislation required a one-time levy on earnings and profits accumulated in foreign entities after 1986. It said while the 16th Amendment outlines the legal definition of income, the Moore case questions whether individuals must, quote, realize or receive profits before incurring taxes. It's an issue that has been raised during past federal billionaire tax debates and could affect future proposals, including wealth taxes. So there's more to this article, but let's talk about the ramification. Like, what does this mean? Okay. This means that if you, in other respects, if the Supreme Court rules in favor of the government tax code that requires businesses to pay taxes on unrealized income, the reason why this could have far-reaching effects on the other side is because that could be a precedent for political players to try to start taxing unrealized income from other places as well. They might justify, the Supreme Court in this case saw that it was okay to tax unrealized income. So that means that they can do it here. What's the problem with that? The issue with taxing unrealized income is the first word in that statement, unrealized. So any of the money that is proposed to be taxed has not been earned. So as an example, you may already get it, but let's just paint an example just in case. You buy a stock for $100, stock goes up to $1,000, and according to, if the Supreme Court rules for that federal entity, you would owe tax on $900 in profit. Here's the problem. You only own the capital gain on that stock has gone up, but you don't actually hold the income for that amount that the stock has gone up. Therefore, the tax bill that you would have to pay based on that $900 increase, if you have not sold the stock yet, is going to have to come out of money from some other place and not from the sale of that stock. Why is that a problem?